Welcome to vTalkInsight, Market Drivers Daily for June 17, 2026. A newly hawkish Federal Reserve and a fragile United States. Iran's ceasefire are now pulling in opposite directions on inflation, yields, and oil. With rates, energy, and geopolitics all in motion at the same time, today is shaping how risk is repriced across global equities, credit, and foreign exchange. The dominant macro story today is a renewed pricing of higher for longer in the United States tightening cycle. Under new leadership, the Federal Reserve has leaned more hawkish, pushing short maturity yields higher and flattening the curve, while expectations for early easing are being pushed out. Going into the meeting, two-year Treasury yields were sitting near monthly lows, just above 4%, even as futures still assigned roughly an 80% probability to at least one rate increase this year. The Fed left its policy band unchanged, around 3.5% to 3.75%, but the projections told a different story. The latest dot plot now shows a higher median policy rate for next year, and about half of officials pencil in at least one additional hike. At the same time, both headline and core personal consumption expenditures inflation forecasts have been revised up toward the mid-3% range, signaling that policymakers see price pressures as broader and more persistent than simply an energy shock. This comes on top of earlier bond market moves, where investors had already shifted from expecting imminent cuts to pricing at least one hike over the next year or two. The message from the Fed is that inflation overshoots will not be tolerated and that 3% is not an acceptable new regime. Markets have reacted quickly to that signal. Two-year yields have jumped by close to 10 basis points, while long-end yields have barely moved, compressing the curve and leaving term premia still subdued. Equities have seen a modest risk-off move, with major United States indices down around 0.2%, credit spreads nudging wider, and the dollar stronger across the board. At the same time, the Fed has halted balance sheet expansion. Asset purchases have slowed from roughly $40 to about $10 billion a month, and officials continue to emphasize passive runoff rather than outright sales. That combination means liquidity is quietly tightening in the background, even without headline rate hikes at every meeting. The transmission of this tightening remains uneven. Housing and some rate-sensitive pockets clearly feel restrictive policy, but strong earnings, especially from AI-driven capital expenditure and large technology names, keep overall financial conditions looser than the policy rate alone would suggest. Smaller, more leveraged companies and parts of credit that rely on cheap refinancing look more exposed if front-end yields stay elevated and quantitative tightening continues. There is still a counter view. Oil has dropped back below $80, the prospective United States. Iran agreement could release additional supply, and long-term inflation expectations remain anchored. Some forecasters still see scope for cuts by year-end if core disinflation resumes and growth slows toward trend. For now, though, the Fed has unanimously reaffirmed price stability as its primary focus, even at the cost of further tightening or a prolonged plateau in rates. The key things to watch are the next inflation and wage prints, how far front-end yields move from here, and whether broader financial conditions finally tighten enough beyond housing to convince the Fed that policy is genuinely restrictive before we add geopolitics and energy into the mix. Turning to geopolitics, the United States. Iran's ceasefire and draft memorandum of understanding remain the key swing factor for energy and regional risk. Brent crude has slipped below $80 a barrel, and West Texas Intermediate is trading in the mid-70s, as markets price in a smoother path for Middle Eastern exports. As we highlighted yesterday, the Strait of Hormuz is central to that story. Today's emerging details point to sanctions relief, the unlocking of significant Iranian assets, and Treasury waivers that would allow immediate crude and petrochemical exports, even before shipping fully normalizes. The draft deal envisions reopening Hormuz and restoring maritime traffic to pre-conflict levels within about 30 days, with Iran potentially adding up to 1.5 million barrels per day of supply. Iran is also reported to be in line for access to roughly $300 billion in development, funding, and frozen reserves, which could materially improve its external position. Yet the risk premium has not vanished. Analysts estimate that close to $20 per barrel of geopolitical premium remains embedded in oil prices. Demining operations require a durable peace, European participation is contingent on a robust and enforceable agreement, and operational bottlenecks mean tanker flows may take weeks or months to normalize. The political foundations of the deal are fragile. In the United States, opposition from some Republicans and questions over a possible $300 billion financing package raise the risk that concessions may not be sustainable. The text reportedly contains ambiguous language on nuclear activity and lacks explicit inspection requirements, echoing past episodes where loopholes were later exploited. President Trump's repeated threats of renewed military action if talks stall, and Israeli skepticism underline that this is seen as an interim ceasefire rather than a permanent settlement. At the same time, regional players are already planning for a world where Hormuz is less central. The United Arab Emirates and others are investing heavily in alternative ports and pipelines, while Europe accelerates energy autonomy and defense spending, helped by European Investment Bank programs. For markets, the near-term balance looks asymmetric. If the memorandum is signed and holds, Iranian exports and stronger supply growth from the Americas could push the oil market towards surplus over the next year, reinforcing the recent disinflation impulse and giving central banks more room to stay on hold. Failure to finalize the deal, or evidence of non-compliance, would likely reprice a much larger supply shock. Inventories and strategic reserves in the United States are at multi-year lows. Asian demand could recover, and there's a non-trivial risk that participants are underestimating the true scale of disruption, echoing mispricing seen during the Russia-Ukraine shock. History suggests equity markets often look through political shocks within a couple of months, but the path can be volatile. The crucial watch points now are tanker traffic through Hormuz, any retightening of sanctions on Russia, concrete timelines for mine clearance, and how G7 leaders link defense commitments to the Iran file. All of these will feed back into the inflation outlook that central banks are already struggling to manage. The third driver today is how central banks, led by the Fed, are pivoting in style rather than through immediate rate cuts. The new Fed chair is signaling a shift away from heavy forward guidance toward a more data-dependent, less scripted approach. Markets have become used to detailed dot plots, frequent speeches, and explicit hints about future moves. Now, the statement has been shortened, explicit references to the employment mandate have been dropped, and the emphasis is squarely on restoring price stability at the 2% inflation target, with no tolerance for what the chair dismisses as too-ish inflation. Behind the scenes, the Fed is launching task forces to review its communications, balance sheet policy, data methodology, and even how AI-driven productivity might affect inflation and jobs. Officials are openly debating the usefulness of the dot plot and summary of economic projections, with some suggesting these tools could be scaled back or reshaped. The goal is for most of this review work to conclude by year-end, which means the framework guiding policy could evolve relatively quickly compared with past multi-year cycles. In the meantime, reduced guidance raises the risk of market surprises around each meeting and major data release. This communication pivot is not confined to the United States. In the United Kingdom, a softer-than-expected headline inflation print has pulled gilt yields lower and prompted traders to scale back expectations for near-term Bank of England hikes, even as sticky services inflation keeps some policymakers leaning hawkish. In China, the central bank is considering adopting an overnight policy rate as its main instrument, bringing it closer to global norms and giving it tighter control over short-term funding costs. These moves point to a world where central banks focus more on the plumbing of money markets and less on detailed public promises about the future path of rates. For markets, the immediate implication is higher event risk around both data and meetings. With roughly 85% of gross Treasury issuance concentrated in very short-dated bills that are highly sensitive to Fed policy, any surprise in tone or projections can have an outsized impact on front-end rates and the dollar. There is a constructive interpretation. By stepping back from steering every basis point, the Fed may restore more genuine market-based price discovery and reduce the moral hazard of an always-present central bank put. The latest plot also shows limited conviction, with members signaling they're willing to revise their paths quickly as conditions evolve. Still, the transition period is likely to be bumpy. Volatility spikes around CPI, payrolls, and energy headlines could become more frequent, especially with geopolitical risks still elevated and AI-driven investment complicating the inflation picture. The key to watch is whether this new communications regime can coexist with the renewed focus on price stability without triggering the kind of policy mistake that would force an abrupt reversal later on. To sum up, a more hawkish Federal Reserve has pushed the United States tightening cycle back to the forefront, lifting front-end yields and quietly draining liquidity even as policy rates stay on hold for now. At the same time, hopes for a United States-Iran deal have pulled oil below $80. But fragile politics, low inventories, and unresolved security risks mean a large energy risk premium still hangs over the outlook. Central banks are also rewriting their playbooks, pivoting away from detailed forward guidance toward data dependence and internal review, which raises the odds of volatility around each new inflation print and policy meeting. The practical takeaway is that cross-asset pricing is being driven by the interaction of policy, geopolitics, and energy rather than any single narrative, and that scenario analysis around these junctions matters more than ever. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.